Hi, good day, everyone. Thanks for that session for joining a webinar by Accounting Yard. And today's one will be on the basics of project finance. Today, I wouldn't be facilitating. However, a professional colleague by name Bambo will be taking today's session. Bambo has over 3 years experience with one of the big fours, in which he does some level of advisory, and is quite knowledgeable in this field we're about to discuss. He would also be facilitating with his colleague, but he would start the session. Bambo, thank you for accepting our invites for this session. We look forward to learning a lot from you. Over to you, Bambo.
Hello, good morning, guys. Please confirm that you can hear me before I proceed. Can you guys hear me? Good morning. All right. Can someone else comment? So, all right, fantastic. All right. Good morning, guys. My name is Bambo Kujamayor. I like Ola said, I have some background in finance, right? I used to work in one of the big four firms. I'll be taking this session alongside my colleague, Biola Georgia. He also worked in a big four firm and is currently in an infrastructure development firm. And yeah, that's it, right, about our introduction, right? And so yeah, I'll just run through this session. I'm hoping that this session will be very insightful for all the participants. So let's just jump straight into it. So the starting points, the topic for discussion, right, is the basics of project finance. And it has been divided into critical elements that we think is critical elements, right, that we think will be beneficial for everybody. One will be an introduction to project finance. Another is the basic terms, right? Next, we'll have a case study on a project finance transaction. Subsequently, we'll have a summary of what project finance risks are. We'll then move to what the role of a financial advisor is. And I think this is very important for us to take note of the role of a financial advisor, because that's where we kind of come into play. And ultimately, we'll then have a Q&A session. So to jump straight into it, right, I'm just going to give a brief introduction right before, the reason why we thought this session would be valuable to the participants, right? So project finance is very critical to the development of any economy, and I would explain why. If you look at the African continent and of course Nigeria as a country, you would realize that we have a significant infrastructure gap. And in Nigeria, for instance, our infrastructure gap is about $3 trillion. And that would mean, using today's exchange rates, that we have about 1 quadrillion naira in infrastructure deficits, right? And that has to be deployed over, let's say, a 30-year period for Africa to unlock its potential. And the way we see it is that the accountants of today should position themselves to have the valuable skills, right? And of course, the knowledge to be able to add value when this capital starts to be deployed across both Nigeria and Africa, right? And that's why over the broader spectrum of you as a finance or an accounting professional, right, would extend to project finance. The traditional roles for accountants is maybe what you do as a financial reporter, an account payables officer, or an auditor, or some sort of advisory. But we've started to see that accountants can also add value to project finance transactions over the long term. And that's pretty much why we think that this session is very instrumental for each one of us, right? So I'll just jump straight into it, to the basic terms, right? So starting points, right? What is project finance? Project finance, right? It typically involves a transaction, right? That is focused on creating revenues, right? And of course, covering the costs, servicing debt, and giving return on investment to project sponsors and investors, right? Before we go forward, I'd like to digress a bit. What you typically have in your organization can be termed corporate finance. So typically, if you're working in an establishment and you're trying to raise whether debt or working capital, all of that is covered under your project or corporate finance lens. However, for specific projects that, like I said, in this case, infrastructure projects, long-term infrastructure projects that are capital intensive, you typically want to go outside that structure, right? To develop a separate entity to raise whether it be debt or equity, right? So that's the background, right? So that's pretty much the distinction between your project finance transaction and your corporate finance. So corporate finance is what you typically have in your traditional organization. However, if you now start to finance infrastructure projects, you then need to move outside that box and get into project finance. So like I said, for you to have a project finance transaction or a project finance deal, right, you must have, of course, a source of revenue that you're looking to unlock, right? And that source of revenue should be sufficient to, of course, cover your running costs, to service the debt, which you typically need to take, right, to finance such transactions, and of course, deliver a significant return to those who have invested equity, right, in the transaction. So that's pretty much a background on what project finance is. So moving on, right, for you to do a project finance deal, like I said, with the background, you traditionally have corporate entities that involved in doing deals and what have you, right? But when you want to invest in an infrastructure project, what you then do is to create something known as an SPV. And I know that we've all heard about what SPVs are, right? It's a special purpose vehicle, right? And it is similar to your company, but the distinction is that an SPV is established for a specific project or venture, i.e., you want to develop a road, i.e., Lekki Toll Gate. At that point, you wouldn't carry that asset on the balance sheet of an existing company, albeit a contractor or the government, right? You typically want to set up an entity, and that's where project finance comes. That's the beauty of it. You can set up an entity that is solely focused on a project. So for some of these projects that you see around, an SPV was actually created to deliver those projects, right? So there's the one for Lekki Toll Gate, and of course, a lot of all these power projects that you see around. So in Nigeria, there's the Azura power plants. There are a couple of others, right? And like I said, significant and large ticket infrastructure projects. So for mining transactions and all of that. And just to bring it home, right? For us as an accountant, it's very important to have like a big picture lens and not see yourself as just someone that is reporting to a boss. We should start to see ourselves as a catalyst for development in Nigeria and Africa as a whole. So that's what an SPV is, right? So the key message on this slide is the definition of an SPV, and I'm sure you've seen it in your financial reporting and corporate reporting material where you see SPVs, as regards consolidation and what have you. So moving on to the next slide, who is a project sponsor? Now, when you want to do a project finance deal, right, as you would expect, someone needs to drive that entire process, right? It needs to start with somebody. So a project sponsor in this case is similar to a promoter of a business, right? So if you conceptualize an idea, right, for a project finance transaction, you are a project sponsor, right? And a project sponsor can range between an individual or a corporate entity, right? And like we had said earlier on, it is the project sponsor that then drives the development or the establishment of a special purpose vehicle, which, like we said, is an entity set up to deliver a particular project. So that's it. Just so I'm sure that I'm not just speaking to myself. Are we all here? Can you guys hear me? Can you just comment in the chat box? So can you guys hear me? I just want you guys. Okay, someone just commented. Thank you very much for that confirmation. All right, so moving on. The next slide is the categories of project sponsors. So think about it, right? There are different people that could play that promoter role in your infrastructure development, right? And as you would expect, the first we have on the list here is a public sponsor. And this public sponsor covers the government essentially, right? So if you want to do an infrastructure project, it could be conceptualized by a government or a government agency or a quasi-government establishment, right? And this makes sense because the government typically has the responsibility to deliver social infrastructure to the public. So the government can act as a sponsor, a project sponsor. There's also in the industrial sponsors. So let's say you have so imagine yourself as you have a power plant, for instance, or you're a power company, and you then realize that given Nigeria's current power gap, you think that there is an opportunity to develop a power plant, let's say somewhere in Kano or wherever it is, right? Because you already play in that space, right? You already have some ideas as to how business can be done in that space, right? You can also come up with an idea and become a project sponsor for maybe the development of, let's say, a 400 megawatts plant, right? So in that case, you'll be termed an industrial sponsor because you already play in the industry. So so there are public sponsors, there are industrial sponsors. Now, another category is purely a financial sponsor. This just means that you just have money, you do not have any industry expertise, and you're also not the government. So as an investor, let's say you have your development finance institution and you have, let's say, $1 billion in capital to deploy, let's say in Nigeria, right? You could also then say, I want to drive the development of the project. So in that case, you be termed a purely financial sponsor. And last but not the least, you could also be a contractor. So say, for instance, if you're a road contractor, right, and you typically get projects, EPC contracts to deliver roads and what have you, right? In the event that the government or whoever is responsible for that project has not conceptualized it or issued out a project, right, you can then decide to develop a project, right, and set up an SPV for the delivery of the project. And this is particularly important because you wonder why maybe a contractor will be a project sponsor. So think about it, right? Nigeria, like I said, we have a significant infrastructure gap. So it would then mean that we need to be more creative as to how we deliver projects. So I'm a contractor, and I think that why isn't there a road linking? Why is Fort Mainland Bridge not yet developed? I then sit down, develop a project, and approach the government to partner with me. In that sense, I'm a project sponsor, right? Although my primary role is to operate as a contractor. So those are the categories of project sponsors we have. So moving straight into it, right? For you to do or for you to close out on a project finance transaction, right? There are specific characteristics that you must look out for, which in this balance is known as a bankable project finance transaction. So for a project finance transaction to pull through, there are specific elements that must be contained in that transaction. So one is that the debtor in the transaction is usually a project company specifically set up with financial and legal independence from the sponsor. Now, what this means is that although a sponsor is required to set up an SPV, the sponsor is not liable for the SPV's obligation. So to put it in context, if I as Bambo set up an SPV, let's say SPV A, for instance, for the development of a power plant, right, I would not be liable to the obligations of the SPV, right? So the SPV will be a completely different entity from me, right? So that's a very distinct characteristic of a project finance transaction. Another is that lenders have limited or no recourse to this. So if I borrow money from you and I furnish a collateral, right? If you have a recourse, right, it would mean that, okay, I want to take a loan of 200 million and I give you my house and say if I'm not able to pay this loan back, you can take the collateral and sell it. So if I don't pay the loan back and you then take my house and sell it, and you're able to just sell it for 180 million, essentially you made a loss, right? You have a gap of 20 million. However, I furnished a collateral. So if there is a recourse on the loan, it means you can come and meet me and sell my car, sell my other items, right? But if there is no recourse, it means you cannot collect any of my assets, right? So what this essentially means is that lenders, right, in a project finance transaction, they cannot claim the assets of the project sponsors. So that's also a distinct characteristic of a project finance transaction. Another is that, and I think this is also very important, is one of the reasons why you typically set up an SPV or do a project finance transaction is to allocate risks between different parties, right? So nobody wants to bear the obligation of developing a 40 billion naira road, right? You need to spread that risk across the different parties. So there are guys providing equity, there are people that will provide debt, and of course, even for the providers of debt, you typically want to split that among maybe five financiers or debt providers. For equity providers, you also have like a mix of equity contributors, right? So risk sharing is a very critical element of project finance transactions. Second to the last, and which I mean, like we already highlighted at the beginning of this session, is that cash flows from a project must be sufficient to cover the operating cost and debt service, right? So I mean, you would agree with me that it doesn't make sense to enter into a project that cannot finance itself or pay back, right? So which is why some of the projects we have in Nigeria has fallen apart, right? So if you say you want to develop a road between connecting two rural communities, right? What is the incentive for you, right? Particularly when you are a private sector investor. So I want to connect two rural communities, it's going to cost me 2 billion. However, there are only 50 people plying that road. So and I'm going to, as a project sponsor, I'm going to be looking for debt financiers. They're going to give me a loan, which I'm expected to pay back. If I then realize that only 52 people are applying that road, they are not able to pay enough, they are not willing, or they don't have the financial capacity to pay tolls on that road, then it wouldn't make any sense for me to engage in such or develop such a project, right? So the project itself, the upside, the revenues or the receipts from the project must be sufficient to pay back the operating costs as you would expect, maybe payment of salaries and what you typically have in your direct and indirect costs. And of course, the debt service, right, is always very critical that for you to ascertain that the project is sustainable in terms of repayment of obligations and covering your day-to-day costs. Last but not the least, right? So, and I mean, I'm going to quickly relate this to your typical corporate finance transactions, right? If you're taking a loan as a corporate entity, what you typically do is that if you're furnishing collateral, you typically use one of your existing assets as security or as collateral to your lenders. But in a project finance transaction, what makes it unique and what makes it interesting is that the receipts and the assets you're developing is actually what serves as a security to the lender, right? So it means the project itself is the security for the project. I mean, it's quite interesting to look at, right? So you're developing a power plant, but it is that power plant that you're using as a collateral for the loan you're getting to develop the power plant. Let me repeat that one more time. You're developing a power plant. However, right, the power plant that is being developed is the security for the loan that was taken to develop the power plant, right? So that's one of the unique characteristics. As this is different to what you have in your typical corporate finance transaction, where you need a separate security as a guarantee for that obligation. So those are some of the characteristics. I mean, there's this of course there are other characteristics, but these are the ones that we think are very critical and we should always be present in a bankable project finance transaction. So, I mean, like you would expect, right? In a typical project finance transaction is a meeting of an entire village, right? There are different parties that need to come together to ensure that the project finance deal is closed, right? And its success is guaranteed. So one is, of course, the project company, which is the SPV, right? Which is the borrower. You're the one taking the loan, right? You also have project sponsors, which could or which will oftentimes also be shareholders in the SPV. Could also have third-party equity investors. These are not the guys that conceptualized the idea. However, they invested after the initial idea had been developed. You could also have your facility agent, which is someone that helps you in securing some of the financing that you need for the transaction. You could also have a bank, right? So there are times where, because of the size of the loans, right, you would have a syndicate of banks to provide a facility to you. So you need 200 billion. Of course, no bank will give you 200 billion. So you now have like a syndicate of 10 banks that contribute $20 billion each to that syndicate or the pool. You also want to have an insurance bank, right? You could also have multilateral and export credit agencies, right? I mean, we can go into the details if you require such details, maybe towards the end of the session. Of course, one party that is also very key is your construction company, because like I said, project financing is usually used to drive large infrastructure projects. So you usually would need a construction company, and such arrangements are usually executed under something known as an EPC contract, which is an engineering, procurement, and construction project contract, right? So typically, you have someone that is responsible for delivery of the project. You also need an operator, right? Which is the person that is responsible, or the entity that is responsible for managing that asset that you developed, right? You also need experts of various forms, right? There's also the host government. Like I said, for infrastructure projects, right? If you want to develop a road, you cannot build a road without getting the necessary approval from the government, right? In addition to that, you need suppliers of where your input material, i.e., if you are developing a power plant, if it's a gas powered plant, right? You probably need a gas supplier. So of course, in that scenario, right, the gas supplier is a critical party in the finance transaction, right? So you need to ensure that all of those, and I mean, in the case study, you see how all of this is brought to bear, right? And of course, where we play, typically, you also need a financial advisor. You need accountants to help you crunch the numbers, to look at your forecast, to say, okay, over the next 20 years, like you typically have in your financial statements, right? What is my forecasted income statement over the next 20 years? How much revenue do I expect to generate? What is my cost? What are my gross margins, right? how much free cash flows do I have? Is it sufficient to pay back the loans? Is it my ratios? Are they sustainable? Are they declining? Do I have what capital cost or what capital cost am I going to be incurring for this project? Do I need to the financing I'm getting, is it sustainable? Do I need to look for cheaper financing? All of those critical issues will need to be assessed by us, the financial advisors, and of course other parties. I mean, there is no limit to the number of parties that could add value, right? Of course, you need your legal advisors. You just need everybody that could potentially help you de-risk this transaction. So thank you very much. Like I said at the beginning, this presentation is in two folds, right? I'm going to, my colleague is going to be taking the other parts of the presentation. Thank you very much for the time, but just to ensure that it's seamless, I'm going to quickly hand over to my colleague Biola. Like I said earlier, is a project finance expert and is going to add more context to some of the background that I've laid so far. So just let Biola step in to continue the presentation. Thank you very much.
Thank you very much, Bambo. Hi, everyone. I know some people had questions during the session by Bambo. Maybe Bambo, beforehand, just take some few minutes to answer questions. I noticed some questions in the chat room, just so that people can actually engage you for a few minutes.
Answer the question. What are the questions? Answer any question.
Okay. So the first question was, what do sponsors get to gain? Are they private equity or holders? That was the only question that came in the chat box, but I guess some other people may have questions so that they can ask questions based on what has been covered so far.
Thanks, Bambo, for the insightful session, and thanks for the introduction. And I take notes of the question, and I think it's a perfect segue into the next session, right? But before we go ahead, right, let me just maybe give another brief introduction. My name is Abiola. The way we're going to be running this session may be a slightly different approach from the first session. Please, as you have questions along the way, feel free to post your questions in the chat box, and I'll answer them. Right. So I think we already know, or at this stage, we already know what a project finance transaction is. So a project finance transaction, just to briefly recap, a project finance transaction involves some sponsors, right, creating an SPV, right, to develop a project. It could be any project, infrastructure project, manufacturing project, such that the revenues from that project goes into repaying both the project sponsors and the lenders to the project. I mean, there are other parties involved in the transaction, and we'll go into that shortly, right? So just to put together all what Bamba said, right? We thought to bring this session to life and relate it to something that's actually happened. I know a lot of us would have heard about the Azura Edo independent power plants. But before I go into the case study, right, let me just provide some background. Right, it's no news. I think everybody here knows that the power situation in Nigeria is nothing to write home about, right? Although there has been strides and efforts to to bridge some of that gap, right? But I don't think any of us has 24 hours power in our houses, probably since when they gave birth to us, right? So thinking about the solution to this problem, some project sponsors, I believe we know what the project sponsor is now. Some project sponsors woke up and say, hey, why do we have so much deficit in Nigeria, right? What can we do to bridge this gap? And they came together to say, okay, let's develop a power plant, right? An independent power plant, which is the Azura Edo IPP, right? Just to provide some context around the project, right? It's clearly located in Nigeria in Edo State. It's a 461 megawatt gas-fired plant. Now there are various kinds of power plant. There's the gas power plant, which is this project. There are diesel run plants. There are hydro plants. Think of your Kanji Dam and the likes. And clearly they are renewables. These days we are seeing energy generation from nuclear and hydrogen, but I think that's a conversation for another day, right? So as I was saying, it's a 461 megawatt gas-fired plant. The project sponsors include a variety of investors. I know Bambo touched on the kind of project sponsors that we have. You mentioned government, private individuals, contractors. In this case, it's a mix of those sponsors, right? We have the Edo State government here. We have ARM Arit. ARM Arit, by the way, is a private equity firm focused on infrastructure. We have AIM. AIM is also a private equity infrastructure firm. We have Amaya Capital and Actis, same definition as well, right? So these guys came together to say, oh, let's develop this project, and they contributed equity to develop this project. The Edo State government contributed about 2.5% of the project cost, which is about 2.5% of the project cost in form of land for the project. I can't remember what the details are right now, but I think it's about 1,000 hectares of land. So there are different ways in which a project sponsor can contribute to a project. It could be through cash, could be through sweat equity, it could be through land. Again, I'm jumping the gun. Let me just continue to provide some more context, right? So I mentioned the sponsors already. The lenders was a mix of multilateral firms, multilateral investment firms, and commercial banks. The funding mix, I'm not certain on what funding mix, but I think it's a mixture of debt and equity in ratio 70 to 30%, right? So I already provided some context on the project sponsors. So these project sponsors came together to develop the project company. So the project company in this case is the SPV that Bambo talked about. So the SPV in this case is Azura Power West Africa Limited. If you notice, if you look at the project sponsors, we don't have anybody that is Azura there, right? So what they did was come together and say, oh, let's create an entity that is distinct from us, such that if anything fails, we are insulated in a way, which was what Bambo was trying to explain, that there's no recourse to the project sponsors, right? So this project cost 900 million. Let's assume that the equity providers, the sponsors contributed 30% of equity. The lenders provided the balance, which 70%, like I mentioned, the mix of both multilateral and commercial banks. And then somebody asked that what is in it for the project sponsors, right? So beyond the developmental impact, we're trying to bridge the power gap in Nigeria, right? Beyond that, there must also be some financial reward for a project sponsor because they are contributing money. So in this case, because the project sponsors are the equity providers, they will get the returns typical of what equity investors would get, and in this case, dividends, right? I'll go back to that, but let me just continue to provide more context on the transaction. So like I mentioned, the lenders provided the balance of project cost and they invested that in the SP, right? So now we have funding from equity providers and we have funding from debt providers. So how do we then go about the project? So one of the first things that project sponsors will do, right, is to enter into an EPC contract. I know when Bambo was talking about parties to a project finance transaction, he mentioned engineering, procurement, and construction contracts. So you have the likes of Julius Berger, Siemens, Now the names are not coming to mind, but we have a lot of those guys, right? So they are technical experts in constructing projects of this nature. Typically, before you decide to choose or to select any EPC contractor, you look at their background, you look at whether they have experience in developing similar projects, whether they have experience in projects of this nature. So, for example, you have some guys that are experts in constructing refinery, right? You probably don't want to use them to construct your power project, right? But of course, there are some firms that have, different internal units, and then they can, do whatever project comes their way. So for this particular project, Julius Berger and Siemens was the EPC contractor. So these guys will clearly move their equipment on ground and then start construction with the funds that has been provided by both the equity and debt providers. Now, in return for constructing the power plant, they will clearly get fees, right? So they will clearly get EPC fees. So a lot of things happen between engaging an EPC contractor and then actually getting the project to run, right? But I'll just skip that, right? Because we're dealing with the basics. So after you have your power plant on ground, right, or as you are constructing the power plant, or probably before you even construct the power plant, you then start to think that, oh, when we have the power plant, how do we generate electricity, right? So that's where the type of power plant comes into play. Now we have, for example, renewable power plants, maybe a solar plant. So in that case, you don't really need, apart from the equipment, right, you don't really need anything to generate power. What you just need is the sun to come out, right? And whatever equipment is on ground will transform that solar power into electricity. But in this case, it's the gas-fired plant. So you actually need somebody to provide that gas for you. Once you find somebody, in Nigeria, you think of likes of Shell, Total, the IOCs, and you can also think of indigenous players as well. But in this case, it was an indigenous player, Seplat Petroleum Company, right? So you secure your feedstock, which is your gas in this case, by entering into a feedstock agreement. And in this case, a gas supply agreement, because gas is the feedstock. Now, for this project, the sponsors or the SPV in this case, entered into a 15-year gas supply agreement. Now, when the project sponsors, think of fantastic projects like this, right? And they go to meet the lenders, right? The lenders will say, oh, beautiful project, huge developmental impact, but they will now bring out their checklist to say, where is the EPC contractor? Oh, you have Julius Berger and Siemens, fantastic. Do they have experience in this kind of project? Oh, they do, fantastic. How are you going to run your power plant? Where's the gas? You say, oh, you have the gas supply agreement with Seplat. We say, oh, Seplat, they have whatever gas field in whatever place in the South, and we are sure that the the capacity of the field they have can, provide power. Is there a pipeline that will link the field, the gas field, to the project? Yes. In this case, that was also why Edo State was chosen as the location for this project, right? Because of the proximity to the pipeline that will supply, that will supply the gas. So as I was saying, the lenders will say, oh, do you have a feedstock agreement? We'll say yes. Okay, then we'll check that box, right? So even the feedstock supply agreement, for how long is it? So for example, let's assume that the lenders are providing money for 20 years or for 25 years, right? But you only have an agreement to supply gas for 15 years. The lenders will say, no, you need to go back to this guy and say, we need additional 10 years of gas supply, right? So once you get that on check, then you will now start think of how to run and maintain the power plant after construction. So that's where you start thinking about your O&M contractor. So we have the likes of V4s and a host of others, right? But in this case, the contractor was Marubeni Corporation, right? So Marubeni Corporation clearly has experience in operating, similar plants. And again, that's what you look at, just like the EPC, you check what the standing of the contractor is, whether they have experience. And in your O&M contract, you ensure that there are enough provisions to remedy the SPV or the project sponsors in case of a failure. So for example, I employ Mr. A or firm A to operate a power plant for me. Firm A, during my preliminary research, right, firm A on paper clearly has experience to, operate this plant, but somewhere along the line, maybe they had shortage of staff or some faults that was caused by them, right? And maybe the plant was shut down for 1 month. So the way the O&M contract is always developed is such that there will be clauses to say if there's any fault if any fault arises and is the fault of the contractor, then they'll have to maybe remedy the project sponsors in this case. So to mitigate against that, sometimes what they do is try to enter into insurance contracts such that any risk can be, or any loss arising from that can be shifted to the insurance provider, right? So you have your project company, right? You have your EPC, which is Julius Berger, that has developed or is developing the power plant. You have the feedstock supply, because Seplat is going to provide gas, right? And you already have somebody that is going to provide or help you run and maintain the contract as you operate it, right? Then the next thing is, who is going to buy this power? I think Bamba also alluded to the fact that the way project finance transactions are structured is such that the revenues are almost certain, right? And those revenues will be used to meet operating costs and pay both lenders and the project sponsors their capital and then additional returns on capital, right? So most times the way project finance transactions are structured is such that you will have a firm or an entity or an individual that has committed to buying whatever the SPV is producing. Take, for example, a gold mine, right? An SPV that has developed a gold mine. So they will enter into an offtake contract with, say, or let's say it's a diamond mine, with, say, the likes of LVMH, DBS, for example, that over the next 5 to 10 years, whatever I produce from this gold mine or diamond mine or whatever, you are going to take it up. So that contract that guides that purchase and sale is called an offtake agreement, right? So for this particular project, the off-taker in this case is the Nigeria bulk electricity trader, right? So in Nigeria, if you provide power more than a particular limit, I can't remember what it is, I think is 100 megawatt or so, you have to send it to the national grid, right? So from the national grid, they then send to distribution companies and they then send to your house. So in this case, the Embeds, I'm sure you guys must have heard of Embeds, is a Nigerian bulk electricity trader. So it purchases power from all the generating companies that we have. I think we have about 10 generating companies in Nigeria. They produce, 8,000 megawatts during peak periods. So they send that to the off-taker. So Embeds entered into an agreement to say, hey, project company Azura will buy whatever power you generate, will buy it off you, right? So the off-take contract specifies things like quantity. I'm sure in this case, the quantity is just whatever comes out of the refinery, right? Specifies price. So for every kilowatt we send to the national grid, we'll pay you, say, $2 or 2 naira, and this currency issue that I mentioned now, we'll see it in the next slide. So we'll pay you either $2 or 2 naira. Again, the price for power will not stay constant at 2 naira for the entire duration of the project, right? There'll be provisions for escalations. So we know that in Nigeria, inflation is crazy. Now we all know what the price of sardine is, right? So in the first year, you pay 2 naira. In the second year, we increase it to, say, 3 naira, like that, and so on and so forth. So all of that is, please, if you're not talking, can you switch off your video? It's distracting, please. Thank you. And you need to embed as an off-taker, for example, has to service the final consumers. Embed to say, hey, I have people that I'm obligated to, right, to provide power to. In any case where you don't provide power to me, right, you must pay me some money, right? On the flip side, the project company can also say, Embeds, anytime I have power, you must also take this power unless you pay me. So that's what we call a take or pay contract. So irrespective of whether you take the product or you don't take the product, provided I've produced it and I'm willing to sell to you, you must buy it. If you don't buy it, you must pay me for it, right? That's what we call the take or pay contract, right? So Embeds then, okay, the power purchase agreement was for 20 years. Again, the lenders will bring out their checklist and say, oh, I'm giving you money for 25 years because projects of this nature, the debt tenor of projects of this nature are usually very long, 10 years, 15 years, 20 years. So in this case, a 20-year power purchase agreement is sufficient. But let's imagine that the power purchase contract was for 10 years. Lenders will say, oh no, you need to extend this off-take agreement to cover the tenor of our loan. Now, I know that Bambo said that, that there's usually no recourse to the project sponsors, right? But because of the kind of risk that a particular project can have, sometimes the project sponsors will have to step in to provide guarantees. So the guarantee will be such that if the revenues of the project is not enough to service the lenders, I'll come and hold you. It's not the typical project finance structure, right? But because of the risks of the project, the lenders will say, no, you need to bring something else to the table, right? And in this case, it will be, you can call it a sponsor guarantee. You can come in different, you can come through insurance, right? So you can say, oh, I'm going to enter into an insurance contract such that if you don't pay me my interest and my principals are when due, these insurance guys will make me whole. But in making me whole, somebody has to pay those premiums, and right? So the project sponsors or the SPV in this case might be the person to pay those premiums, right? Another way that lenders can be covered is for third parties to provide guarantees. I already mentioned that we can have sponsor guarantees. So in this case, Amaya Capital, AIM, ARM, and Edo State government can say, oh, if we're not able to service your obligations, right, we'll bring in our own personal money. The lenders can also, the SPV, just to de-risk the project, right, the SPV can also enter into a guarantee arrangement with the likes of MIGA. So MIGA the full meaning of MIGA is Multilateral Investment Guarantee Agency. It's a World Bank related entity, right, and they provide guarantees to emerging countries to undertake risky projects. IBRD also provided a guarantee on this project. IBRD is International Bank for Reconstruction and Development, also a World Bank related entity. Now, for this particular transaction, right, there were a lot of firsts, right? So if you notice, I have something on the screen that says that the PPA is backstopped by put call option with the FGN. Now, recall I mentioned that sometimes the sponsors can come or rather the lenders can request the sponsors to provide personal guarantee, right? And for a project like this that is critical to Nigeria, I think what the lenders did at that time was to ask the federal government to provide. The government were like, hey, our debt levels are going up. We're not going to provide any guarantee. We don't want to be obligated to these projects. Then they now created a very, very crafty structure to say, okay, fine, don't provide a guarantee, but you can provide what we call a put call option. Now, what backstop means is a guarantee. It's just big English guarantee, right? So what a put call option means is the project sponsors can put back the project to the federal government of Nigeria. So when you are putting something, you are basically selling the thing. So the project sponsors are saying, if Embeds is not paying me revenue for the project, for the power that I have produced, or if, for example, NSAS happens, right, and Embeds kind of take, or I can't produce, or maybe the PPA contract is terminated for whatever reason, right? The project sponsors will sell the project to the government, and the government is obligated to buy the project, given provisions in the put call option, right? And the amount that the project will be sold to the government to be such that it can at least cover what they are owing the lenders at the very minimum, right? Now, what the call option be to say, maybe the project becomes very fantastic, Nigerians become very rich, they can pay for power the true cost, or we now have industries so that demand is high and everybody's willing to pay some crazy amount for power, right? So what the government can say is, this project is now a lot more viable than we thought. We are going to buy this project from you. So that's what they call part of the option, specifying, right? Clearly, this put call option is one way to mitigate one of the risks associated with this project, right? And that will take me to the next slide. But before I go ahead, let me just check the chat box if there's any question. Okay, so no questions so far, so I'll just move on. So I'll be flipping between the previous slide and this slide, right? So typical risks in a project finance transaction. Of course, for a particular project will have its own specific risk. Clearly, there are also generic risks that every lender or project sponsors needs to be able to address. But like I said, I would try and as much as possible to relate this slide to the previous slide. Now, so what I've done on this slide is to show the probability of the risk for this particular Edo Azura project and the impact of the risk if it materializes. Now, the first risk is force majeure. So what that means is an action that cannot be stopped. It's an action that's created by God, really. So maybe things like earthquake, tectonic movement. I mean, we're lucky in Nigeria, we don't have a lot of those things, right? So in the case that something like this happens or maybe a pandemic, for example, right? COVID-19, people could not fulfill contracts, right? So in a case like this, there would have been provisions in the loan agreement that if something like this happens and you can't service me, this is what will happen. Sometimes they will say, oh, it's a pity. Nothing can be done, so we just wait. Sometimes we say, oh, it's a pity that nothing can be done, but you must pay me my money, right? All of those provisions will be built into the contract. So the probability of this happening is low, but the impact clearly will be high. Imagine an earthquake happens and just rips apart the power plant. So the next risk is the demand/market risk. Now, at the beginning of my presentation, I mentioned that Nigeria has a huge supply power gap, right? I think currently our generation capacity is about 13,000. Of those 13,000 megawatts, we can only access 8K. And due to distribution losses, I think what ends up in my home, your home, and the industries and factories that we have is just about 4,000. So it's clearly inadequate. So the risk of low demand or market risks is very, very low because people want power, right? People want to stop, putting on their gen and rely on themselves to create power, right? So the risk of that for this project is low, right? That's why we have low probability. But just imagine that for some reason, half of Nigeria is wiped out, right? And we don't have enough demand to meet the project. The impacts will clearly be huge, right? So the next risk is O&M risk. So like I mentioned in the previous slide, there was an O&M contract with Marubeni Corporation. So the things you check for, and O&M risk includes things like risk of shutdown, risk of a fire, during the operational phase of the project, risk of thefts, for example, somebody or a group of people came to steal some of the critical equipment in the plant. So the O&M contractor is supposed to be able to provide enough expertise to run the project, enough security around the project site and all of those things, right? So in this case, the risk is medium, but the impact will be high, right? Move to the next risk, which is feedstock supply risk. So imagine that, and with all the issues that we have in Niger Delta, imagine that on one funny day, the Niger Delta militants wake up and go to vandalize one of the pipelines leading to the power plant. Clearly, the power plant cannot generate any power because the most critical input is gas, right? So the probability of that happening to this project, to be honest, is medium, right? Because I think in the last 4 to 5 years, we have not heard a lot about pipeline vandalism. Like I've heard about Boko Haram and the likes, right? So in this case, I'll say the risk is medium, but if it happens, the impact is very high. So the next risk I'll touch is E&S risk. So what E&S means is environmental and okay, we have a question. So before I touch on that, let me just. Yes, I'll leave that to Ola, but I think yes, it should be able to get the presentation. So the next risk is environmental and social risks. So what this covers is how the project will impact the environment and people's livelihood. Like I mentioned, the Edo State government provided, I think, about 1,000 hectares of land for this project. So imagine that people had farms on that project site. Means that they will have to find somewhere else to grow their produce, right? So you have displaced those people either from their settlement or their means of livelihood. These days, the world is, really, really laser focused on E&S risks, right? Likes of IFC and all the other multilateral agencies that you have are very, very keen on a project being socially sustainable, right? So in this case, what I would have said is, yeah, it's fine that you have to displace people, right? That's if there's no other project site that can suit the project. However, what you have to do is you have to be able to relocate those people to another location, provide another means of livelihood for them. So maybe you displace their farm, you need to provide another land where they can farm. And sometimes you even need to provide them cash for resettlement, right? So all of those things will be built in during the project development phase. Environmental risk is, since it's gas powered, I'm sure there will be some form of emissions. So the lenders can require that the emissions or the CO2 emissions shouldn't be beyond a certain level, right? Because this is what is moving towards renewables. On construction risk is in threefold, right? The first risk is time risk. The second risk is cost risk. And then the third risk is, right? So for time risk, so imagine that the lenders and the sponsors are provided both debt and equity, right? And they're saying that we expect that this project will be completed in 3 years. So imagine that the project was not completed in 3 years, but completed in 5 years. Monies have been tied up into this project and we just delay returns to the sponsors. So that's time risk, right? Next risk is cost risk. The sponsors and the equity providers have committed to providing, say, $900 million for this project. And just before completion, maybe there was a devaluation or prices just shot up, significantly. And now we need 1.5 billion to complete the project. That's created a significant risk because the sponsors, we have to go and seek for additional funds to shore up that financing gap, right? And it takes time. Sometimes it takes up to 2 years to raise funds, right? The third risk is the specification risk. Assuming the project was completed on time, within budget, but after 3 months, the power plant collapses, or what he built was the plants that he built can only take a specific kind of gas, right? And the gas that they have is of another type. So that's also a specification risk. Let's assume that the project is supposed to generate 500 megawatts, but the way they have built the plant, it can only generate only 300 megawatts. So that is also a construction risk. Now, how do you mitigate this risk? So in the EPC contract with Julius Berger and Siemens, there's something they call a lump sum fixed contract. So they can tell Julius Berger and Siemens that. So in this case, I'm guessing Julius Berger was the contractor that actually built it, and Siemens was the equipment supplier. So they provided all the equipment required for a project. So as I was saying, in the EPC contract, they have built-in provisions to say, hey, Julius Berger, you provided a quote to me, right? And this quote that you provided says that we'll need $900 million to complete this project. I have built-in escalations, that's inflation, to say, oh, we know it will take 3 years. In the second year, the price of this thing have gone up. Okay, perfect, fantastic. If you don't complete this project with this $900 million I'm giving you, whatever additional cost that we need to complete the project, Julius Berger, you must provide it, right? They can also say something like, once we start this project and something happens, right, within 6 months. So let's assume that the project cost is 900 million, right? So there's something they call, now it's not coming to my head, but the way it works is to say, for every milestone that you reach, so let's assume you clear the site, you put one equipment down, you put the second equipment. So the way it works is the EPC contractor is paid at every milestone until the entire $900 million is paid, right? So what they will do is, after the first milestone, let's assume that what we're supposed to pay the EPC contractor is 50 million. We will retain 10% of that 50 million, 5 million, and pay them 45 million. When the second milestone is reached, we'll pay them, let's assume it's 100 million, we'll pay them just 10%, we'll keep 10% and pay them 90 million. I think it's called retainer, but I can't remember what the term is right now for some reason, right? So when you put all those money together, let's assume that it's 10% of the total project cost. So at the end of the project, you have 90 million, but you have a completed project. If nothing happens to the project within the next 6 months, then you pay the balance of that 90 million to the EPC contractor, right? So that's another way to mitigate the risks. Or maybe a part gets worn out quicker than expected. So of course, the replacement cost for that part will come from that money that has been retained, right? So those are some of the ways that we can mitigate construction risk. So next is interest rate fix. So if you look at these lenders, right, sometimes they can provide debt at a fixed. Okay, I think there's a question. Yeah, it's called retention. Thank you very much, Kunle. Yeah. So interest rate risk. Lenders can either provide money at a fixed interest rate or at a floating interest rate. Now, a fixed interest rate is saying, I'm providing you loan for 10 years at 10% fixed, right? A floating interest rate will reference or will be based on some reference rates. Now, a reference rate can be either LIBOR, NIBOR, Euribor, and what have you. Now, those are called reference rates. Some of you might know about it, but LIBOR is currently being phased out, right? But again, that's a conversation for another day. So imagine that the lenders give you money at LIBOR plus, maybe 6-month LIBOR plus 7%. Assume that LIBOR is, I think 6-month LIBOR is around 0.7-ish, now I can't remember, right? So they will borrow money at 0.7+7, right? Imagine 3 years down the line, LIBOR is now 0. So they get only, so in the first 5 years, LIBOR was 0.7. So they get 0.7 plus 7%. After 5 years to say about 7 years, LIBOR drops to 0. So from 7.7%, they now get 7%. Now let's say LIBOR drops below 0, so say minus 0.5, they now start getting 6.5, right? And we've had, I think, very recently or even currently, I think Euribor is about 0 or maybe below 0%, right? So that's a risk for lenders. Now, on the flip side, let's assume that the SPV starts paying LIBOR plus 7% and LIBOR was 0% at the start of the contract, at start of the debt agreement. 5 years down the line, LIBOR has increased to 1%. Now they start paying 8%. 10 years down the line, LIBOR has increased to 2%. They start. So there's that risk from a floating, a floating interest rate. So there are ways to mitigate this. Where sometimes they enter into a floating to fixed interest rate swap. So what you do is, if you have a fixed contract but you want floating, you pay somebody the fixed rate and the person pays you the floating rate, or the opposite, whichever is applicable to you, right? So the next risk is political risk, and in Nigeria we have a lot of political risk. Although Nigeria has been operating in democracy for about 98 to 2018 years, 2018, 20 years, for over 20 years now. Right, so we have had, like, they call it seamless transition between one democratic government and the other. But we know clearly that Nigeria is not political risk free. I mean, look at months ago, or no, it's even a year next week, there was a certain, protest, right? And that could have impacted the project. And that could have impacted the project. I mean, there could be several, political risk could arise in several ways. And one way to mitigate that is to enter into a guarantee arrangement. So the likes of MEGA and IBRD, they provide political risk insurance for emerging or developing countries, of course, at the price, right? So the price can either be paid by the lenders, can be paid by the project SPV. If it's to be paid by the lenders, it's to be built into the interest rate, such that if this country or this project doesn't have any political risk, instead of charging you, so I'll charge you 7%. So now let's assume that we know that there's some form of political risk, right? We'll charge you maybe 3% extra, 2% extra, so that we can use that extra to pay the premium, right? So the last risk, which is very, very critical to Nigeria, right, is the FX devaluation risk and illiquidity risk. We have seen how the Naira has devalued from whatever it was years ago to what it is currently. Let's assume that the power purchase agreement, that's this agreement here, right? The off-taker is committed to paying the project company in Naira. But to build the power plant, you have to import whatever equipment you need, and that equipment is priced in dollars. Now, because it's priced in dollars and you need dollars to pay, the project company or the SPV or the project sponsors will seek dollar-denominated debt. Now, because they have sought dollar-denominated debt, they have to pay back the lenders in dollars, but they are getting Naira revenues. Let's assume they get 1,000 Naira in the first year, which is very fine to cover the loan obligations during the first year. In the fifth year, Naira has devalued to about half of what it was in the first year. So now you have only 500 Naira, and now there's a problem, right? Or even sometimes, because you have built in enough escalations into the PPA agreement to say, oh, in next year, you're paying me 15% extra. So you can have a lot of Naira, but you don't even have where to change your Naira. The black market is not as robust for a project of this nature, right? So imagine that you want to service $20 million in debt. You possibly not be able to meet your ability to change it for you. Or even if you go to the official market, right, there might not be enough liquidity for you at that point, right? So there's that risk of illiquidity and valuation rate. So again, there are several ways to mitigate this kind of risk, right? So one of the ways is to build a dual currency mix into the PPA agreement, because we know that Nigeria is essentially in Naira, right? So you don't want to make the PPA only dollar denominated. So what I can say is let people pay 40% in Naira and 60% in USD. Of course, what they will pay eventually is 100 Naira, right? But 60% of that agreement will be priced in dollars, such that whatever the exchange rate is at that particular point in time is what they will now pay, right? So it's a form of risk sharing between the final consumers and the lenders. Another thing you can do is to enter into a currency swap, right? Because you're expecting Naira revenues. You can go and meet some investment bank. I mean, Nigeria's market is not as robust. I think the CBN provides forward contracts. But what you can do is to say you're expecting 1,000 Naira in 5 years, but you also have dollar obligations of $100 in 5 years. Let's swap, right? So you swap at a fee, right? So a project finance transaction can have way more risks than this, right? But this is what I was able to think about and ways to mitigate some of those risks that I've highlighted. Again, I'll stop here to see if we have any questions. Where's the chat box? So no questions for now. So I'll take it that the presentation is going smoothly, right? So moving on to the next slide or the next phase of the session, which is the role of a financial advisor. Now, Bambo mentioned that we need to think of the bigger picture beyond being an accountant. We need to think about to solve problems, particularly national problems. So maybe not today, but next year, 3 years down the line, you could find yourself in a company owned by a potential project sponsor, and they will need you to help on a particular project, or even within your current company, now that you have the idea of how a project finance transaction can work. So let's assume that your company wants to expand, wants to build a new plant in Kano. So rather than borrowing money on the company's balance sheet, which is corporate finance, like Bambo alluded to, you can create a separate SPV such that the recourse stops at the bulk of the SPV, so no recourse to the sponsors, or in this case to your company, maybe because the transaction you think is very risky, right? So there are a lot of ways financial advice. There are a lot of situations where you can find yourself needing to play the role of a financial advisor, right? So one of the things that a financial advisor is expected to do on a project is to advise on sources of debt and likely financing terms. So in the previous slide, I mentioned that I think the project funding mix was about 70-30, right? So 70% debt, 30% equity. Even if the project sponsors have their 30% cash ready, they need to source that balance of 70%. Now, the financial advisor in this case, they have relationships with multilaterals, with commercial banks, and with a host of other people that can provide debt, right? They will also advise you on what the likely terms are. Say, oh, some of these guys provide at 7%, some of these guys provide at 80%, just to prepare your mind. They will also advise you on the optimum project financial structures. Rather than doing 70-30, they can say, no, project of this nature is usually 80-20 or 60-40. And they can also tell you, rather than doing a straight senior debt, right? You can also do a sort of subordinated debt, or you can do a mezzanine facility or preference shares or what have you, right? They will also advise you on implications of project contracts and negotiations of funding. In fact, what they do first is tell you what contract lenders would like to see. Like I mentioned, EPC contract, offtake agreement, feedstock supply contract, O&M contract. So those are some of the basic contracts that is usually required for projects of this nature. And the financial advisor will help you negotiate and ensure that you have all of those on check. So they also provide assistance to prepare your financial model, because like I mentioned, imagine that lenders are providing 700 million in debt. They need to be sure that the project can repay both the principal and interest obligations. And how can they know that? Is by building a financial model. I know it's just a model and nobody can really predict the future, right? But it gives an indication of what the project will look like when operation commences. So those kind of projects are called project finance models, and they are usually more robust than your normal financial model, and they're usually very long term. So you see a 20-year model, sometimes a 30-year model, and likes. So they also help in assistance in bid preparation. Sometimes the project concept will be so fantastic, right? So let's assume you have just one project sponsors and is looking for other project sponsors, or even if you have all project sponsors that you need and you're looking for lenders, right? Sometimes the project concept can be so fantastic that you have more than enough commitment, enough financial commitment that you need, and you now tell them to submit a bid. Now, this is the financial advisor acting on the other side, right? So the financial advisor, let's assume that I'm Bank A and I like this project so much. I like the returns that it's going to churn out, right? And I want to participate in this project. I can engage a financial advisor to help me put together my debt terms or put together my expression of interest or what have you, just to be able to participate in the project. So they also help with assistance in negotiation with public authority. Like in this case, I mentioned that there was a pool call agreement with the Federal Government of Nigeria. So the Federal Government of Nigeria will also have financial advisors on their part, and the project sponsors or the lenders will also have financial advisors on their part, so they can help in all the relations. Sometimes you need regulatory approvals to undertake certain type of project, right? You also need engagement and somebody that has existing relationship with the government just to fast track that way. Then preparation of info memo and presentations during roadshows. Now you have this fantastic project, right? And you're approaching lenders or maybe other project sponsors to come in on the project. You can't just, even for this training, I have a presentation that I'm speaking to, right? So in pitching your project, you also need a presentation, a document that talks about the project in detail, right? So the financial advisor can also help you on that. And then last but not the least, they can advise on selection of commercial bank lenders or placement of bonds for you. So maybe you don't want to go the traditional bilateral debt way. You can say, oh, rather than meeting this bank, A bank, B bank, C to provide debt for me, I can float the debt on a bond market. So I'll say, hey, whoever is willing to subscribe to the debt that I need to finance this transaction, right? Just come in and bring your money and purchase a piece of bond, right? So I'll check if there are any questions, and I'll, of course, give 5 minutes before we move to the closing remarks, just in case you are still typing your question or thinking about what to ask.
I did tell you that time.
So I'll take it that we don't have any questions, and I'll assume that we delivered a good presentation. Just to wrap it up, right? Oh, somebody just asked the question. You mentioned O&M risk. What is O&M? Sorry, maybe I forgot to mention for me of that. Right? So part of the service providers that we have are EPC contractors and feedstock suppliers. Right? We also have what we call O&M contractors. So O&M means operations and maintenance. So after you build your plant or whatever you want to build, you need somebody to help you run and maintain that plant. Bambo mentioned that sometimes project sponsors can be purely financial guys, right? They don't have any experience whatsoever in operating or even developing a power plant, but they can now enter into an agreement and operations and maintenance agreements with somebody else that has expertise, right? And in this case was Marubeni Corporation. So those ones will help you run the plants. They will help you secure the plants, whatever it takes to convert the gas being supplied to power, right? They'll help you do everything, right? They'll maintain the equipment and whatever. Yeah, so that's what O&M means. I hope that answers your question. Any other questions before we call it a wrap? I'll wait for 30 more seconds. So I'll take it that there are no questions. Oh, I think I just joined. Can you help summarize, or will there be a link to download the video? Yes, I think there will be a link to download the video, but just to summarize, right? So this session was about basics of project finance, right? So there are several ways to fund your project. It could be through your own personal money, it could be through money from other people, it could be through a company going to the bank to borrow money. But there's one peculiar way, right? And it's called a project finance. It's called project finance in our project finance structure. So the way it works is to say, I need to undertake a particular project, right? Let's say to build a power plant, like the case study that we just touched on. So a group of people will come together. This group of people, or maybe a particular person, are called project sponsors. Now, a project sponsor can be the government, can be financial, it can be financial investors, it can be a contractor, or it could be maybe institutional entity, right? So those project sponsors will come together to develop the project. So and how do they do this? They will create an SPV, or a project company. An SPV means a special purpose vehicle. Now, this special purpose vehicle will be a separate entity, a very, very separate entity from the project sponsors, such that whatever happens, such that there's no recourse to the project sponsors in case anything goes wrong. Now, the SPV will also be funded by lenders according to a specified funding mix. So lenders can range from commercial banks to multilateral agencies and what have you. Now the SPV will now engage an EPC contractor. An EPC contractor is an engineering, procurement, and construction contract to build whatever you want the project to be, right? They also engage a feedstock supplier. So let's assume that in this case, I mentioned a power plant. The feedstock supplier, a gas power plant, the feedstock supplier in this case was Seplat and supplied gas to the plant, right? Then they'll also engage an operations and maintenance contractor. So that O&M contractor will help, run the project during the operational phase. Now, another striking feature of a project finance transaction is that most times the revenue stream are usually contracted and set in just before we start operations. So in this case, I think I should just flip to the slide. So in this case, the off-taker in this particular transaction was Nigerian bulk electricity trader Embeds. Now the off-taker and the SPV project company will enter into an agreement, right, such that the off-taker buys everything produced by the project company. So in summary, project financing involves a transaction focused on creating a secure source of revenue. Secure source of revenue in this case is through the off-take agreement to cover operating costs, which will be done by the O&M contractor, service debt, which will be to the lenders, right, and deliver a return on investment to project sponsors in form of dividends to them. I hope this summarizes what we have done so far, but I'm sure you can also get a video. Who bears the loss in the case of a loss, right? I think I need to go back to the slide. So there are a number of people or there are a number of parties that can suffer a loss, right, in a typical project finance transaction. In fact, all the parties can suffer a loss. The first party that can suffer a loss is the project sponsors. Imagine that the project doesn't do as well as it should do. They will not get equity returns, they will not get dividends, or they will not be able to exit if they want to. And their money is gone. The lenders, in this case, they won't be able to get interest and principal, so they can also suffer a loss. The off-taker in this case can suffer a loss because the off-taker might have also entered into another contract with the end buyers. And if they can't provide whatever they are contracted to provide, they can also be exposed to a loss arising from non-performance, right? So everybody in this slide can suffer a loss, but that is why we usually build sufficient mitigants or mitigating clauses into whatever contract we enter. So like I mentioned, the PPA in this contract is backstopped by a pull cut option with the FGen. And what does this do? This minimizes the risks for the project sponsors. Imagine that the project fails or embeds backs out of the PPA contract. The project sponsors can sell the company to the government at a price that will cover whatever money has been borrowed and even provide some returns to project sponsors. The lenders, in this case, also try to mitigate their risk by entering into a guarantee provided by MEGA and IBRD. So what this guarantee does is more or less like an insurance. So in a case where this SPV is not able to repay interest and principal, MEGA will step in and repay the principal and interest. For the EPC contractor, like I mentioned, the EPC contractor might not build the project according to specification or on time or within budget. So there could be provisions in the contract that says, if you don't do what we have specified for you to do in this contract, you will bear the loss, so you will make us whole, right? So there could be several ways to mitigate the risks such that maybe one party doesn't fully bear the loss or the risk is shared. And there's something we call a risk sharing arrangement in project finance transaction where all the risks that the project is exposed to, there are clear provisions as to who and how the risks will be shared or whether it will be transferred to somebody else entirely. How can one get involved in project finance to work on real life projects? I'm guessing you're asking this question from a perspective of somebody that wants to learn or wants to experience what a project finance transaction is like. There are several rules in a typical project finance transaction. You can be the project sponsor, you can be the lender, or you can be anybody, right? So for the project sponsors, clearly before they embark on the project, right, they will need somebody in-house to check if the project even makes sense and if the project is viable. For the lenders, they will need somebody to check whether the project can repay both the interest and debt. So there's a lot of modeling involved as well. So to be able to work on a real life project, you might need to be working for a project sponsor or for a lender, or maybe if you're an engineer, you can be working for the EPC contractor. Again, if you're an engineer, you can be part of the O&M guys. So, and there are a lot of firms in Nigeria that can provide you that opportunity, and I'll leave you to do that research. Any more questions? Okay, so I'll take it that that's everything that I have. Thank you very much for your time, for listening to both myself and Bambo for the last 30 minutes to 1 hour. I hope that I've been able to, shed some light on the way project finance transaction works. And there are a lot of projects in Nigeria that I think maybe were funded by government. Like, for example, the Lekki toll, for example, you wonder why they are still collecting toll. It's just to provide some returns to the lenders and also the sponsors as well. Yeah, so thank you very much, guys. I'll leave it to Ola to just provide some closing remarks and bring this session to a close. Thank you.
All right, thanks a lot, Biola. Thanks a lot, Bambo. You've done justice to this, right? The funny part is that me personally, right, I've been working on something related to a project finance project, and it was quite interesting listening to it, seeing an entire picture than just involved in the transaction before it comes to light. And it was quite educative for me. So it was really a well-detailed one. For those who took time out of their busy schedule to attend this seminar or webinar, we really appreciate everyone. The videos will be available on YouTube, typical like most of other webinars we've had in the past.